In this video, we'll show you everything you need to know about Forex trading, fast. Forex is something that affects your life every day, whether you're buying a coffee, filling up your car, or going on vacation. These things happen thanks to the power of Forex at work. Plus, we've included a free beginner's Forex trading guide that goes with this video. We'll show you how to get it later. So, what is Forex anyway? The word Forex is short for foreign exchange. It's the world's biggest financial market. Imagine a giant global market, but instead of selling products, it trades world currencies. The Forex market trades more than $6 trillion every day. And unlike the stock market, Forex is open 24 hours a day from Sunday 5 p.m. to Friday 5 p.m. Eastern Time. You might ask, where is this Forex market? Well, it's not in one place. Forex is everywhere. It's a decentralized network made up of banks, brokers, dealers, and even governments, all trading currencies with each other. Also, hit that like button to help us keep making free videos like this one. Let's now talk about some basic terms you should know. Each currency has a short 3-letter code called an ISO code. Here are a few. USD is the US dollar. AUD is the Australian dollar, also called the Aussie. NZD is the New Zealand dollar, the Kiwi. EUR is the euro. CAD is the Canadian dollar. GBP is the British pound. JPY is the Japanese yen. And CHF is the Swiss franc. In Forex, we trade currencies in pairs because you buy one while selling the other at the same time. For example, let's take the GBP USD pair. The first currency, GBP, is called the base currency, and the second, USD, is the quoted currency. If GBP USD is 1.12655, that means for 1 British pound, you get 1.12655 US dollars. When you buy GBP USD, you're expecting the pound to go up and the dollar to go down. If you sell it, you're expecting the pound to drop and the dollar to rise. Now let's explain major currency pairs. These always include the US dollar and are great for beginners because they're the most liquid, meaning they're easy to buy or sell with tight price differences. In Forex, price changes are measured in pips, which stands for percentage and point. It's the smallest price move a currency pair can make. Most pairs show 4 decimal places, so if AUD USD moves from 0.6751 to 0.6752, it moves by 1 pip. But with Japanese yen pairs, it's different. They only go to 2 decimal places. So, if JPY moves from 146.22 to 146.23, that's a 1 pip gain. A pipette is 1/10 of a pip, shown as the 5th decimal place. Before we go on, tell us in the comments what topic we should cover next. And don't forget to hit that like button to support our channel. Next is lot size. This is how much you're trading. A standard lot is 100.000 units of a currency. A mini lot is 10.000. A micro lot is 1.000. And a nano lot is just 100 units. Then we bid and ask prices. The ask price is what you pay to buy currency. The bid price is what you get when selling. The spread is the difference between these two. It's like the cost of entering a trade, and it also includes the broker's profit. Some brokers offer fixed spreads, and others offer variable spreads that change with the market. Now let's talk about brokers and leverage. You need a broker to trade Forex. Brokers give you leverage, which means borrowing money to trade bigger amounts. Think of leverage like a lever that helps you lift heavy things with little effort. Financial leverage helps you control large trades even with small money in your account. For example, a broker might offer 150, 1 to 100, or 1 to 500 leverage. That means with $100, you can trade like you have $5 or more. But be careful, leverage can increase both profits and losses. You'll need to deposit some money as margin, which acts like collateral for your trade. Let's explain liquidity. Picture a huge ocean where everyone is trading, but each trade is just a tiny ripple. That's what Forex liquidity is like. It's a place where tons of trades happen all the time, so it's easy to get in and out fast. Then there's volatility. If prices move fast and a lot, that's high volatility, like a wild roller coaster. More risk, but more chance of reward. If prices move slowly and stay steady, that's low volatility, like a peaceful train ride. Less risk, but also smaller rewards. Things that can cause volatility include inflation, global news, political changes, disasters, or central bank decisions. So how do traders figure all this out? They use 2 types of trading strategies: technical analysis and fundamental analysis. In technical analysis, you study past price charts to spot patterns. It's like being a detective. If something happened before, it might happen again. For example, if prices keep making higher highs and higher lows, that's an uptrend, and you might want to buy. If prices keep making lower highs and lower lows, that's a downtrend, and you might want to sell. If prices often bounce from a certain line or area, that's a support or trend line, and traders watch for the next bounce to make a move. Now comes fundamental analysis. This is where traders look at the big picture, like a country's economy, political news, inflation, unemployment, or interest rates. It's kind of like doing a weather forecast, but for money. Traders use tools like economic calendars to track news that can move the market and help them decide when to buy or sell. And now, as promised, if you want the free Forex trading guide that goes with this video, just go to the description below and click the link to download it instantly. Please like this video so we can keep making helpful content. And don't forget to comment below with the next topic you'd like us to explain. Thanks for watching, and we'll see you in the next video.